Hi, everybody, and welcome to the Direct Private Investments Show. With me is Bruce Roberts, the CEO and founder of Carofin. And in this video, we're going to be talking about why direct private investments, what are they, and really what are the kind of outcomes that an investor can look to achieve or realize through the direct private investment space. So, Bruce, I'd love for you to kick us off with just give us the elevator pitch very quickly. An investor is usually, let's just say, him or herself is trading on the public markets in whichever way, shape, or form. They don't know anything about direct private investments and what the hell that actually means.
Right.
So why don't you fill them in on exactly what is direct private investments?
Well, let's go a little higher altitude because an even more opaque term we use is alternative investments, right? And alternative investments can be everything from a real estate investment that you might do personally, which many people are quite familiar with. And that's roughly half of all alternative investments. Investments in a commodity fund could be an alternative investment. Anything private of a private nature, meaning it's not registered with the Securities Exchange Commission, is by definition going to fall in the alternative investment bucket. And by the way, we're talking about $6 trillion of investment. So this is an enormous, enormous category. It's actually larger than the public market, but it gets broken into different pieces. In the case of Carofin, and in our case, we're talking about investments in operating companies, right? So in real businesses, and in our case, small to medium businesses. And these could be companies that are at a venture stage, venture capital, and they could be well-established businesses that are in kind of the middle market. They might have, 25, 50, $100 million in revenue, some number of employees. But we're not talking about large companies. We're generally not talking about private companies, or public companies, although you can invest privately in a public company, probably not for today. Why would you do it? It's an inefficient market, broadly speaking. And where there's inefficiency, if you can find advantages. If you're investing in the public markets and you're a stock picker, well, you just have to appreciate that you're competing against the entire mass of global Wall Street, if you will. You've got research analysts who spend careers, probably have PhDs in those sectors. Probably the biggest advantage you have, in my opinion, if you're stock picking in the public markets, is time. You can sit on an investment, you can ride through down cycles and up cycles, whereas your professional investor, they're managing a fund, probably has more of an imperative and incentive to get out of your losers, and maybe, who knows where the stock's really going, but they've got to make quicker decisions. But you got to realize that, you are fighting the street. When you're in the private markets, you have virtually no competition. It's an inefficient market. It's pretty unusual for the earlier stage companies there to be people lined up down the street to invest in this company. These securities are sold, not bought by and large. And yes, we tell a story. What we also do that's incredibly, so we're doing due diligence on a company. We're structuring a security that's appropriate for that issuer, and yet we think is a fair deal for the investor. And by the way, if we don't bring fair deals, investors don't repeat with us on a repeat basis. And that's an efficiency for us. And we have many, many investors that have done dozens of transactions individually with us. So, if you will, the market kind of dictates that we're going to bring a fair deal. It has to be a deal, or we want it to be a deal that the issuer can service, can meet the terms of the deal. But by the same token, the risk return that the investor is getting for this needs to be fair. So, why would you do this? There's a lot of technical reasons from an investment and portfolio theory we could talk about. I also think, frankly, there's a whole bucket of human side of it. This is an opportunity to invest in companies that are doing things that are meaningful to you. For example, in the last year, we financed a company that provides a software platform that supports addiction treatment. There are roughly 14,000 addiction treatment providers across the country are of a size that can benefit from this. And if they're more efficiently managed off of this ERP system, they're going to deliver better treatment. And there's a lot of people in the world, if not most people, who have some tie to mental health or addiction issues. And this software support the professional can do that. We financed a company that, allows you to sterilize surgical instruments remotely without electricity, without water. And that's a huge deal. Otherwise, you need an autoclave, which needs a lot of both. And that dramatically expands the footprint of where surgical procedures can be delivered. We finance companies that provide replacement parts to the commercial aircraft industry. If parts aren't available to repair airplanes aren't going to fly for whatever reason, and I think that's probably important to all of us. So, and then I guess I'd also say, for me personally, one of the hot buttons, given where we are in history, is we're now at a point where sovereign risk is back on the table, and where our country, United States, has been outsourcing manufacturing now for 30 years. They're finding that, wars do happen, supply chains do get disrupted, and, America and other countries, Europe doing the same thing, for that matter, Central America, everyone's having to look more domestically at how products are produced and supported. And, that's an incredible opportunity for communities of investors to get together, to get behind an investment theme that's important maybe to their community. So you can't do that necessarily through a fund. And in this case, with the direct investments, you make the decision, you choose where your capital goes. The rub and the challenge is it's not an area that has a tremendous amount of professional support as far as the banking community. And then we're a pretty unusual beast in terms of taking this on. And the reason I dare say you won't see much support is it's a really inefficient process relative to how Wall Street works. But, we get up every day trying to make it a more efficient, process, an adequate process from many levels, but also an efficient process.
One of the key things, Bruce, that I've discovered through my conversations with you is that there's just a lack of transparency, So if you are a investor looking for alternative investors, but now specifically with the lens of the direct private investment space, where you have these growth companies that are, looking to raise equity or debt capital, in many cases, I've discovered that investors just don't know that these opportunities exist.
Well, transparency is a loaded word in our industry, right? Because transparency typically in a securities investment perspective suggests an overt effort to obfuscate information. I think maybe where you're trying to go is, where does an investor go to have a sense of how you approach the analytical process of looking at a private company? Mm-hmm. Okay? There's the problem with the private companies, there's no guardrails in place. If you go out and you buy a debt instrument in the public market, it has a credit rating from Standard & Poor's or Moody's or Fitch, and you can be reasonably sure that a single A company is a stronger credit than a C-rated company, right? A lower junk bond related. You have that. If you go in the equity markets, if it's a large enough stock, you can be pretty well assured that there's market makers in that stock. There are equity research firms that are providing research on that stock or on that industry. And you can lean on that as you're making that investment decision. Smart, very dedicated, very focused professionals are doing that. They're not perfect either, but that's what they spend their lives doing. That's probably where their education comes from. So it's not a bad way to look at a stock. You get into the private markets and you're pretty much on your own, but for someone like us, who's making a profession of this or building a business model around it. So personally, I find that pretty exciting as a business opportunity for us. That's why we do it. Is it scalable? We've come a long way in the last 27 years. I think events like this, where we impart some of the skills that we've learned, so you can begin to grab those frameworks, those guidelines, and we're big believers in giving back. So whatever we've learned, this is not some hyper-competitive environment. We've got to kind of hold that close to our chest. We're quite happy. If you go to our knowledge base, you might be surprised how much information is there within Carofin.com that tell me if you find it anywhere else. But I think you basically got to go to a school like the Carofin Institute, which is where your professional venture capitalists go. And some MBA programs have a focus on this now, but it's tough information to get.
When you mentioned market timing, and obviously, COVID impacted a lot of markets. 2008, we touched on. When does an investor consider direct private investments?
I think the simple answer there is it's a high risk category. you need to look across your portfolio, and you need to look at a certain allocation of that portfolio, typically 10, for less liquid individuals, maybe 10%. For those who are extremely liquid, maybe 20%. You might be interested to know that some of the bigger investors in alternative investments, when I talk about funds and stuff, are university endowments, because they're going to be, in these investments for a long, long time. They never expect to eat at the corpus of the endowment. They might have 40% or even more of their portfolio in alternatives, because it's a good fit. When you talk about an individual, we're obviously all on a life cycle here, and it's going to evolve from kind of your age to my age. I'm probably about 30 years older than you, and you think a little bit differently in terms of, do I buy, investment in a startup company that I might be holding for 10 years and might be successful, versus, I'm not happy with what I'm getting out of my bond fund to kind of meet my daily bills, and I'm looking for some current income. I would say you should never be in this sector of the market if a return of capital is essential to your lifestyle. It's just too high risk. On the other hand, there's that kind of sector there where you can afford to take greater risk to reach for greater yield, but you're going to need a support network. And that's a large part of what we provide, whether we're supporting on the deal selection side or what is rarely talked about, post-investment. I can't tell you how many transactions of the hundreds we've done that would have suffered more if we had not been in an ongoing support role, looking after the relationship with the investors. And when I have a client that I'm raising money for, I'm quite clear with them, today I'm raising money for you, but you need to know I've got another master over here, an investor. But when the money moves, and my allegiance has to be with the company, with the individuals that have put their capital in this deal. I have an obligation to them. And so, I would say investment bankers are by definition conflicted. We just are. We raise money for companies, and yet we sell securities to investors. And I do think, getting back to the transparency question, taken in a literal sense, where you stay out of trouble, and we've never had any trouble in this regard, is you go out of your way to make sure everybody knows the scenario, good and bad, and no company's perfect, and then that people can make an educated decision.
Bruce, what's your advice to an investor that's watching the show right now and they're like, that sounds really interesting. I would like to maybe explore the world of direct private investing a little bit in a more serious fashion.
Right.
What's your advice to a first-time investor considering your world?
Outside of just calling us?
Yeah, yeah. Just call Bruce.
Yeah, you're right.
Well, put his number in the show notes.
In all seriousness, the website, I mentioned it earlier, the knowledge base. We've been assembling that for the last 4 years. Lots of white papers, some videos, lots of articles, linked to glossaries. There's a lot of jargon in this business. And so every article that you read has a hyperlink to a glossary where we've tried to make it understandable in layman's terms, right? I don't know of another place you can find that information. It will turn into a book at some point, I'm fairly confident. But we take the attitude that if we want our both everyone around this equation, the issuer, the investor, to be dealing with full knowledge of what's going on, and it's a big plate to fill. Other than that, I do think, gosh, there is more out there than there used to be. On television, obviously Shark Tank has made it fairly famous, in terms of looking at earlier stage businesses. That's not really reflective of the world we work in. We're talking about products that companies that tend to be a bit more mature than that. With kickstarting, the Kickstarter movement that kicked off, with the Jobs Act, going back, I think it was 2016. On the one hand, I applaud the democratization of investment in this area. On the other hand, I'd urge a huge word of caution that, investors in this sector tend to, it's kind of like in this part of the country, there's a lot of fly fishing. And, when you fly fish, it's about how you present the bait, right? And they tend to jump at something that's shiny and sparkly. And that's not really the way to go about private investing, but that is kind of the way that a lot of the private investment kind of goes. For me personally, I like really boring businesses that have a business model that just, is relatively obscure and creates this opportunity where there's margin and where you can really, investor and the company and the investor can jointly make some good money. So I don't know that there's a free lunch here. You need to become somewhat passionate about the sector, and you need to be committed to looking at as many sources of information as you can. Again, our knowledge base, I think, is an excellent place to start. If you get on our newsletter, the sort of things we share includes books that we're reading and things that we're finding that are teaching us things. So that's the other neat thing about this sector. You're always learning. I'm either learning because of the industry that we're financing and there's something I didn't know about it, or I'm learning even still, how can we do a better job, vetting these deals and bringing them support.
So Bruce, let me ask the question a different way. Why Carofin?
Let's start from the premise that you're looking to dramatically enhance your portfolio in terms of the potential returns that could come out of it, but also in terms of the variety of transactions you might look at, and in terms of being able to participate in deals that are meaningful to you. Well, if you look at the process that we bring a deal, it starts on the origination side. And, due diligence as a word gets thrown out there a lot, but we're going a lot deeper. Well, we're starting at a fundamental level to say, does this business model even make any sense? But now you're talking about personal background checks, liens and judgment searches. You're talking about a level of research that you as an individual investor in all likelihood couldn't do. And even we've learned through that process where we've learned you've got to pay up to have the deeper level of database that you can go through. You need to read the court transcripts if for whatever reason there was some kind of something going on in the person's background. You also want to know who you're investing with. It's not just the company you invest in, but if you're in a syndicate of investors, how are these other folks going to participate if, let's just say, they happen to miss their financial projections, which by and large, all venture stage companies do miss their financial projections. Well, where do you think that company is going to go for the next round of financing? Or they're going to go to the investors that are already in it. You need to have some assurance that that company's not going to drive off a cliff and there are other investors at the table who can help carry that load. But then now you've invested in the company and you want to know, well, what's going on with this business? I can tell you from experience, one of the great challenges of investing, and for that matter, banking young companies, is once the money's moved, once the money's in the company, they've moved on to the next crisis. How do I make the product? How do I sell the product? Have I sold enough of the product? And eventually you're going to get back around to illiquidity, but there's a window of time there where if somebody's not aggressively working with the company to get information out, good or bad, on what's going on with that investment, you're going to be flying blind. It's really easy to write a check. It's really hard to get your money back on one of these deals. So we're with this not just from the origination portion to make sure it's a deal we want to represent and to make sure it's a deal that might be suitable for you as an investor. We're riding along with you to do everything we can to help that company succeed. We're providing referrals to other parties we know, which we're not taking fees for that kind of stuff. Anything we can do. By the way, we do take equity warrants or options in their stock as part of our compensation. So we're with you where we're also incented to do everything we can to make that company successful, even when we're not getting paid a fee to bank it or something. It's just part of our universe of companies, much like a venture fund in that regard. But I think I probably threw out a few things that if you're going this completely solo, one, it's hard to imagine unless you've spent the last 27 years doing this full time as a career that you've amassed a body of knowledge or resources, frankly, that we bring, much less have another part of your organization that's totally geared towards that post-investment support to try to make sure these are high-risk deals and they have to have constant attention. And if they don't, much more often than not, your surprise is not going to be a good one. If you get to the challenges early enough, then many businesses can make it to the finish line. But, you also have to know that the entrepreneurs themselves, nobody has the full kit bag, and every company's got its weaknesses. And so we're looking at the companies from that perspective to say, what can we do to mitigate risk on this deal, on this company, and try to help it succeed? So it's kind of a mouthful, but yeah.